Good afternoon and welcome to our session on accounts for non-accountants. I'm Eddie Finch, one of the partners in the charity and not-for-profit team here at Buzzacott, and I'll be presenting along with Amanda Francis, one of my partners in the team, and Matt King, a manager in the team as well. We're going to take you through the session. We'll have a quick look at the agenda before we start. So part one is an overview of the key requirements of charity accounting, the statement of recommended practice, and Matt will take you through that. In part two, I'll look at some of the more judgmental aspects of charity accounting and the kind of areas that trustees might need to probe a little more about when you're exploring. And in part three, Amanda will take you through the trustees report, which, as she'll explain, is a very important component of the report and accounts and explains a lot more than the numbers ever could. And then hopefully at the end of the session, we'll have time for a few questions and answers, and we'll take those and the ones we receive, which we can't respond to this afternoon, we'll give you in writing afterwards. So just before we start, a little bit of housekeeping. So as attendees, your webcams and cameras are off, but you can use the question and answer panel on the right-hand side of your screen to send us questions, and if they can, the team will deal with them if they're to do with the running of the session, or otherwise we'll pick them up in the Q&A at the end. As I've said, if we don't get to answer questions that you come up with during the session, we'll answer all of them in a written response that we'll send out to everybody at the end. We are recording the session and everybody will be able to access a copy of the recording and the slide deck after the event. So let's kick off without further ado with Matt.
Thank you very much, Eddie. So for the next 20 minutes or so, I'm going to be talking about how the format of a set of charity accounts differs from the format of a company set of accounts, and also some of the specific requirements of charities and the documents that govern those requirements. So let's go back to that first question. If we go to the next slide, please. What does differentiate a set of charity accounts from a set of company ones? Well, the short answer is charities are required to make significantly more disclosures than companies due to the fact that they're established for the public benefit, and there's therefore a high level of interest in their activities, as well as an expectation by the public of how charity money is spent. Charities also engage in very particular types of income and expenditure transactions more often than companies, so for example, making or receiving donations and grants. And as a result, charities must not only follow the financial reporting standards applicable for companies, but also a specific document which interprets those standards for charities, gives detailed guidance on the presentation and form of additional disclosures for charities, as well as a bit of advice on how to account for more unusual and charity-specific transactions. Now that document is called the Charities Statement of Recommended Practice, or SORP for short, and that's issued by a joint committee of members from the Charity Commission in England and Wales and OSCR, the Office of the Scottish Charity Regulator. Now, if we go on to the next slide quickly, under the Charities Act 2011, compliance with the SORP is mandatory in order to give a true and fair view of the state of affairs of your charity. That's if you're using an accruals basis of preparation. Now, I'll come on to talk about what that means in just a moment's time. There are a few exceptions to charities that don't need to use the charity SORP, and examples of those sorts of entities are those to whom a different SORP applies. So, for example, further and higher education colleges and housing associations, those sorts of exempt charities. Now, I mentioned just a moment ago that the SORP applies to all charities preparing their accounts on an accruals basis. So if we move on to the next slide, we should be able to see at the top that there are two types of ways to prepare an account, two methods for preparing accounts. Charities with under £250,000 of income can apply the cash or receipts and payments basis of preparation for their accounts, whilst charities larger than this must follow the accruals basis and the requirements of the charity's SORP. It's also worth noting at this point that incorporated charities, which are registered companies, must apply the accruals basis regardless of their size. So that's all very well, but how do these two methods of preparation differ? Well, under a receipts and payments basis, cash receipts and payments are recorded as income and expenditure at the moment that cash changes hands. Nothing could be simpler. Under the accruals basis, however, we match income and expenditure to the period in which the services are provided or activities take place, regardless of when that change in cash takes place. So, for example, let's say that I'm a theatre-based charity putting on productions and I've got a December 2021 year end. So in this example, I might have performances taking place in December 2021, so pantomimes for example, and a different performance taking place in early January 2022, let's say a costume drama. Carrying on this example, let's say the box office receives a cash payment in early December from a Mr. and Mrs. Smith who've booked tickets for both performances. Under the cash basis, I would recognise that entire receipt as income in the year ended 31st of December 2021. Under an accruals basis, however, that January 2022 performance doesn't fall into my financial year. It falls after the 31st of December year end. And as a result, I would defer that income. I wouldn't recognise it as income, but as a liability on my balance sheet to reflect the fact that the event was taking place after my financial year. Once we get to the December 2022 year end, we can release that liability back into income and recognise the income in the period to which it pertains. There are a few more specific rules for charities, which we'll come on to after we've had a look at the format of the financial statements. But it's worth just mentioning on this slide as well that we're showing the audit threshold for charities here as well. So charities with income of above £1 million are required to obtain an audit under statute. There are other conditions which might require a charity to have an audit even if they don't have £1 million worth of income, and indeed many charities which are smaller than that threshold do prefer to have an audit just for the sake of transparency and the extra assurance it provides the trustees over the management of the finances. If we move on to the next slide quickly then, this slide gives an overview of the key components in a set of charities accounts. The first three areas are the wordy narrative elements, which give more of a qualitative overview of the charity. Amanda's going to be talking about the trustees report in the final part of the session. The penultimate item is the accounting policies, which deal with some of those subjective or more judgmental areas and decisions on how the charity accounts for specific items. Eddie's going to be having a look at some of those in just a moment. But before he does, I'm going to cover the rest of those areas on the slide where the numbers are presented, with a particular focus on the statement of financial activity, SOFA for short, the balance sheet. We'll skip over the statement of cash flows in this section, but we will cover the various notes to the accounts, or a few of the more important ones for charities. So moving on to the next slide, before we have a look at the structure of the SOFA, that's our statement of financial activity, here's an example of a typical company's profit and loss account, which many of you might be familiar with. For those of you who aren't, however, this is a simple linear table which essentially tells the story of a company's finances throughout the year in question. We start with income or turnover at the top, then we deduct costs of selling products or services, any administrative costs, add back sundry income, and finally deduct tax to arrive at the overall profit or loss for the year. Now, most charities aren't subject to taxation, so don't worry too much about that. Where they are, it's a bit more complicated, so we won't deal with that in this particular session. And let's move on now to the next slide and have a look at what's specific about a SOFA compared to a company P&L. So as with a company's profit and loss account, this is essentially a summary of income and expenditure, telling that financial story for the year or given accounting period. But unlike a company's profit and loss accounts, the transactions are presented on an activities basis, subdivided into specific types of funds depending on restrictions on the use of income, which is an awful lot easier to explain with a visual example. So on the next slide, we'll be able to see an example of a SOFA. And you can see immediately that the presentation is far more tabular and there's an awful lot more going on than on the company's profit and loss account. There are also significantly more subheadings, although substantively we do still start with income in that table at the top, deduct our costs in the table in the middle, and end up with a surplus or deficit for the year, the equivalent of a profit or loss for a not-for-profit organisation, about 2/3 of the way down the page there. Now, right at the bottom, we add our surplus or take away our deficit from the funds of the charity, so everything that it holds in terms of finances brought forward, and come to the balances of the funds at the end of the financial year, right at the bottom. So let's have a look at some of these differences in a bit more detail. Firstly, we'll start on the next slide with the columns. Now, these relate to the different funds of the charity, which, as we've discussed, are split depending on any conditions over the use of the funds imposed by the donor on receipt. Here we can see the simplest type of fund, the unrestricted fund. Now, this represents money received with no conditions or strings attached to its use, and it can therefore be applied towards any purposes that the trustees wish, provided the expenditure is in line with the charity's objectives. Now, the trustees can, if they desire, ring-fence amounts within the unrestricted fund to use on specific purposes, projects or activities. These internal ring-fenced amounts become known as designated funds, and generally the trustees should be setting a clear time frame for expending those funds. They can, however, release them back into the general unrestricted fund at any time because the ring-fencing is purely internal. On the other hand, if we look at the next slide, restricted funds with external conditions are shown in a separate column. These relate to money received with very specific instructions from a grantor or donor and must therefore be applied in accordance with the donor's wishes under trust law. Now, a charity can only spend those restricted funds on purposes other than the restriction if they get prior permission from the original donor, which can be quite difficult if you've got a significant number of very old funds whose original purposes become unclear. So it's best to make sure that you are very aware of those restrictions and not hanging on to those funds for too long. The next slide shows the third and final type of fund, the endowment fund. Now, these are a lot less common than the other types of funds, and usually the ones that the trainees in our firm struggle to understand the most, so worth a bit of explanation. They're best thought of as highly restricted funds, which are generally received as large sums donated to form capital for a charity. Now, that capital might be held in the form of an investment or an investment property and is usually used to generate income, which can be applied towards charitable purposes. We have two specific types of endowment funds. Firstly, permanent endowments, which, as the name suggests, must be retained in perpetuity under trust law and can't be expended other than in very specific circumstances or after a legal intervention. On the other hand, we have expendable endowments, again provided as capital amounts, but the gift is made in such a way that the trustees can, if required, convert part of the original capital into income to apply to charitable purposes. But generally there is an expectation with an endowment fund, regardless of whether it's expendable or not, that it will be held as capital in the medium to long term if it's classified as an expendable endowment. Let's turn now on the next slide to have a look at the rows on the sofa rather than the columns. Now, as we saw, there's a lot more detail on a charity's sofa than a company's profit and loss, mostly because charities have a wider variety of income and expenditure, and also because we want to be more transparent about what our charity is doing compared to a private company. Under the SORP, charities are required to report on an activities basis in order to show how they use their income to support their charitable purposes. Now, in practice, that means that every income heading has a corresponding expenditure heading. There are some examples on the slide here, and I'm going to go into them in more detail on the slides that follow. So if we move on to the next slide, the first of our headings on the income side is donations and legacies, which includes general donations and legacies, as you would expect. It should also include, however, any grants for the charity's core activities, as opposed to specific projects, as well as any donated assets and the value to the charity of any gifts in kind or pro bono work that the charity's received. Charities can also carry out trading activities, for example, running shops, selling services which are generally outside their charitable objectives, renting out unused space, holding fundraising events, and various other sundry trading activities. Some of those might be undertaken by a trading subsidiary for tax purposes. And all of that income would be consolidated into this next line, the other trading activities line. The final heading on this slide for income is income from investments, which not only includes income from dividends and distributions from listed investments, but also your bank interest. On the expenditure side, on the other side, we match this income off against the equivalent costs for these activities, so the costs of raising those funds, which all comes under the single heading expenditure on raising funds. So that includes the cost of raising donations, carrying out trading operations, or managing listed and property investments. Now, these figures can be potentially sensitive, as funders do often look at the fundraising costs relative to charitable expenditure in ratio form, just to see how effectively a charity is using its funds. If we move on to slide 14, onto the next slide, please. The other major income and expenditure headings on the sofa are the actual charitable activities of the charity themselves. So here you should be splitting out all of your individual activities. And the key items of income to recognise under those individual lines of activities are, for example, direct payments for the activities from or on behalf of beneficiaries. So we have on the slide the example of care home or school fees. But you also need to be recognising in this section any grants related to, or restricted rather, to specific projects or activities, rather than the general ones we were talking about above. You should also be including here any specific performance related grants or contracts. Now, as we saw above, the sort requires you to have equivalent expenditure headings. So under the charitable activities headings in expenditure, you're likely to be including the vast majority of the charity's costs for the year. And as you can see on the slide, the direct costs of the charity's activities would be included here. For example, staff costs, the provision of aid, materials, or any grants being paid out by the charity. And you'd also include any allocated support costs which hadn't already been allocated to expenditure on raising funds at this point. So moving on to the next slide, now we've seen how to present the income and expenditure. How do we recognise them in a given year? I talked a little bit earlier on about the concept of accruals accounting, but in the charity sort we said there are some extra rules relating to how income and expenditure can be recognised, as well as just the time in which an activity is taking place. So in order to show income in a set of charity accounts in a given year, the charity must be able to meet all three of the criteria which are set out on the slide, i.e., is the charity entitled to the income? Is the receipt of the income more likely than not? That's how we define probable in the charity sort. Or can the income be measured reliably? So let's have a look at a grant receipt as an example of that. If I receive a simple notification that my charity is going to be granted, say, £50,000 with no strings attached, that letter sets out absolutely no conditions that I need to meet in order to become entitled to the income. So I meet the entitlement criterion at the point of receipt of the letter. The receipt of the notification letter in and of itself shows me that receipt of the money is probable, more likely than not that I'm going to be paid that money eventually. The letter, the notification, also clearly gives the amount of the grant, £50,000. So I meet the measurement criterion as well. As such, I meet all of those criteria and I'm able to recognise the income in full at the point of the notification. And that's regardless of whether or not the cash has come in. So that comes back to our concept of accruals accounting. Now, if the cash hasn't come in, we recognise the income, but the second half of that entry becomes an asset on the balance sheet, recognising that we're owed money by the grantor. Let's say just for a moment that the grant agreement states the charity isn't entitled to the income until it meets specific project objectives, or that grant might be clawed back unless those objectives are met. In that circumstances, when we get the letter through, we don't meet the entitlement criterion. We only meet that requirement once we've delivered that project for the grantor, and we can't recognise the income until after that point. I've got legacy income on the slide there. Legacies are a bit more complicated, and really all I wanted to touch on here is that the amount of time it takes for executors and solicitors to actually pay out legacy money because of the legal hoops that they have to jump through mean that quite often these criteria are met well in advance of the cash appearing. So if you do see legacy income in a set of charity accounts, it's more likely than not that there will be an equivalent debtor or accrued income owed to your charity rather than the cash having actually been received. If we move on to the next slide, we can see that the rules on recognising expenditure mirror the ones on income. So the criteria are very, very similar. Probability of payment and measurability are very much the same as for income. However, instead of entitlement, expenditure is recognised when there is either a legal or constructive obligation to make a payment to a third party. Now, a legal obligation is quite simple, quite clear-cut, and it's a requirement arising from a legal contract. Constructive obligations are a little less straightforward, but essentially they arise when the charity has created some sort of valid expectation of making a payment to a third party as a result of a past event. So the third party is expecting a payment for whatever reason, and that might be because you've notified them in writing. Again, as with the income, all three criteria here need to be met in order to recognise the liability. I'm not going to give you an example here because I'm running out of time, so we'll move on to the next slide and an example of a charity balance sheet. Now this, for anybody who's seen a company's balance sheet, is very similar. The statement gives a snapshot of a charity's financial position at the end of the accounting year, following on from that story told by the sofa. The bottom half shows the total funds at the year end, which we've carried forward and copied over from the bottom part of the sofa. And that's balanced on the top half by the equivalent value of the charity's assets, so in cash, investments, equipment and so forth, less any liabilities, so money owed to other organisations by the charity. We're going to do a very quick whistle-stop tour through the assets on the next slide. So starting off with the assets, we have our fixed assets. These are long-term assets, items of significant value and cost, which have useful lives of more than 1 year, for example, motor vehicles, buildings, computers, and so forth. Now, Eddie's going to talk about how we write those assets down over their useful economic lives momentarily. Most charities, or many charities, hold investments, which are used to generate additional income. Now, they might comprise stocks and shares or properties which the charity rents out to generate income. Regardless of the type of investments, all investments must be shown at fair value, which in its simplest form is equivalent to a market value. Now, that's particularly easy to determine for stocks and shares because there's a plethora of data available online, but an investment property might need a more specialist valuation by a surveyor if you've acquired one for your balance sheets. Now, sometimes a charity could hold a property which is used for both its operations, so it meets the definition of a fixed asset, but also has areas within the property that are rented out and is also meeting the definition of an investment property. In this case, the SORP requires the charity to split those mixed-use properties between its functional and investment components. The functional component is held at cost and depreciated, and the investment section is shown in investment assets and gradually revalued each year to its fair or market value. At the bottom of the slide there, we have some examples of current assets, stocks held for resale, debtors, which in their simplest form are monies owed to the charity by other parties, although note that those may also include our accrued income, so income which has met the recognition criteria but has yet to be received in the form of cash, as we've talked about earlier. And the last item there, cash itself, which hopefully needs little explanation. On the next slide, we have a summary of the liabilities on the balance sheet. So these will include amounts which the charity owes to other individuals or organisations and are usually split between items to be paid within a year and those falling due after 1 year. Usually, the short-term liabilities include invoices requiring payment, so trade creditors, accruals, which are invoices which are estimated where you don't have the invoice at the year end, and any amounts due to the tax office in the form of NI contributions, VAT and so forth, as well as any bank overdrafts. You might also have some income received in advance of the year to which it pertains or in advance of an activity taking place, which would be held here as a liability until it can be recognised. So that harks back to our example of the performance post-year end, would be treating that as a liability. Items due in more than 1 year might include deferred income, but more often than not, they're going to relate to long-term grant commitments payable over several years, or possibly bank loans if your charity has any outstanding loans. There are certain circumstances as well in which charities are required to show long-time liabilities for defined benefit pension schemes on the balance sheet. But these are quite complicated and have very, very specific accounting rules. So we're going to leave that as an awareness point today rather than going into the detail. One of my last slides here now is just to have a quick look at the notes to the accounts and some of the specific disclosures to charities. So I mentioned at the start of this section that charity accounts are required to provide a great deal more disclosure than company accounts. And 2 areas in particular this jumps out in, one of which is staff costs. Generally, you don't tend to see an awful lot of detail on staff costs in a set of company accounts, but charities need to give a breakdown of the staff costs by gross pay, national insurance contributions, pension contributions, severance payments and so forth, as well as giving the average headcount, the average number of employees. Now, companies are required to report remuneration of just their highest paid director, but charities have a slightly different disclosure and need to report the number of employees earning more than £60,000 per annum, split into bands of £10,000 each, i.e. the number of people earning 60 to 70k, the number earning 70 to 80k, and so on and so forth. It's very important here to note that you don't need to name individuals or give exact salaries there. And charities also need to disclose the total remuneration of their key management personnel, being the individuals, including the trustees, in charge of directing and controlling the charity. Remuneration in this context simply means all gross wages, employers' pension contributions and NIC contributions, and any non-monetary benefits. And now the second point on that slide is related parties, which are considered at the simplest level to be any individual in charge of controlling the charity, i.e. the key management and particularly the trustees, or somebody with a close family or personal connection to those individuals, such as parents, brothers, sisters, children, or spouses. And any organisation controlled by any of those individuals is also considered to be a related party to a charity. Now, transactions between a charity and its related parties must be disclosed in the notes to the accounts. So you need to be disclosing the value and nature of any transactions, along with the relationship of the connected party and any amounts outstanding at the year end. And this just harks back to the importance of transparency in charities as public benefits entities. Because of charities' nature as public benefit entities, you also need to be disclosing the aggregate value of expenses paid to trustees, as well as the number of trustees claiming those expenses, as well as the aggregate value of donations made by trustees to the charity. And again, it's important to note in both of these cases that no individual trustee is named, nor are specific individual amounts of transactions given. Moving on to the very last slide I have now. This is just a short note before I hand over to Eddie on deadlines. So incorporated charities, that is those charities registered with Companies House, must file their financial statements 9 months after the year end with Companies House. The Charity Commission deadline for filing is 10 months after the year end, but just be aware if you're registered in Scotland with Oscar, you have a 9-month deadline as well, so don't get caught out by that. Now that's everything I had to say on my section, so I'm going to hand over to Eddie to talk about the more subjective and judgmental areas of the accounts at this point.
Thanks a lot, Matt. Thanks a lot, Matt. So what I'd like to do is that there are a few of the things that Matt explained that were clear in principle, but in the detail sometimes get a little trickier, and one or two areas where a lot of the purpose of this session really is to help trustees who look at accounts and need to understand whether the information is credible, reliable, etc. Just to know what kind of questions to ask, because there are judgments and decisions that can be made around accounting policies, for example, that can lead to very different outcomes despite the underlying circumstances being almost identical. So on the next slide, there's just a quick summary of the things I'd like to cover. These are just a few areas where those judgments come in. The first little section's a little bit sledgehammer to crack a nut, but we'll go ahead with it anyway, just to have a look at the sort of difference between detail and aggregation. Get signs of financial weakness, going concern, and that kind of issue is very important just at the moment. And we'll look at a couple of the ways that accounts can usefully help you very quickly see if there are problem areas around that. Matt mentioned designated funds, and those are funds set aside at the discretion of trustees, and that discretion is something that can be manipulated to give a better or worse account of what the charity is doing with its funds. And we'll just look at some of the criteria that make a difference there. The secret of great accounting, just like comedy, is timing, and Matt talked about those issues around recognition, and although the principles are fairly simple, there are some key decisions in both income and expenditure recognition that can make a very big difference to the financial position of charity reports, and we'll just look at where those might come. And then the final little section is really just looking for the things a charity might not say, or that might have hidden and buried somewhere very deep in the accounts that should get you asking more questions. And as I say, the whole purpose of this session is really around being able to ask the right questions and tell the difference between charities' accounting decisions, rather than trying to set you up with preparing accounts yourselves. But hopefully these will be useful tips. So we'll start with the first section, which, as I say, is a little bit sledgehammer to crack a nut. But on the next slide, we'll see. There's a presentation here of a simple expenditure summary that you might see for a charity. And a few things jump straight out at most people who would see a slide like this, and unfortunately those few things are usually the wrong things. So we can all see a couple of spelling mistakes sitting in amongst that. We're all wondering what the heck the auditors are doing, charging half as much again as they did last year. But most of us might not have sort of really clicked that the cost of providing services has gone down by a really significant amount year on year. And there's a big change in the balance of activities going on in the charity. So on the next slide, we've shown a slightly different presentation. What we could very usefully have done. So we might usefully just have bundled up all those last 4 items under a heading of sundry or miscellaneous or something, because we don't want to spend the whole meeting quibbling about the cost of stationery, etc. We've spelt a lot of the words properly this time, I hope. But also, I think the key thing really that we're trying to draw out here is that you need enough detail in amongst there to differentiate. So if we had 4 or 5 services, for example, having that big block of 5 million odd isn't very helpful. We want to know which services are spending more, spending less. We certainly don't want people getting drawn into detail they shouldn't be going anywhere near. So those little headings at the bottom shouldn't really be there. And really at trustee level, we should be avoiding micromanagement. So as I say, a bit of a blunt instrument to hammer home a couple of points about good accounting presentation, but hopefully they've helped us all reflect. Moving on to the next section. I've said that solvency is a very important aspect of charity accounting at the moment. A lot of charities have struggled with the situation over the, well, I was going to say the last couple of years. I mean, there was the financial crisis before that too. Going concern and financial distress have been at the forefront of a lot of organisations' minds. And the importance of good disclosures around going concern, which is the accounting principle that an organisation will be able to continue to operate in a reasonably recognisable shape for the foreseeable future, has become a lot more important. But the key things really to emphasise here are that everybody's making disclosures about going concern these days. We're required to encourage clients to say why they think they should prepare accounts that are going concern, even if they clearly do think they should. And it's good practice to draw out the uncertainties and assumptions that have been made behind that, but also to address them head on. So there'll always be uncertainties around next year's income for many charities, but you can express your confidence that you've got good relationships with your donors, etc., etc. I think the key thing to emphasise here is disclosure of going concern was something that those of us of a certain vintage will remember used to give everybody the heebie-jeebies. It's now expected that the phrase will be used in a set of accounts. But the key thing it should do is give you, if you look at a set of accounts for years and years and they're always on a knife edge, then you might start to have concerns. But if there's a good reassuring story behind what the organisation is doing to deal with any uncertainty, that will give you confidence. Simple point brackets in a set of accounts. Usually brackets mean a number is the wrong way around. So where there should be a surplus, there's a deficit, for example. I've said usually there because things like creditors are sometimes presented in brackets as common practice. But if you see an awful lot of set of brackets around the numbers in a set of accounts, you should start wondering straight away what's going on. Assessing solvency, usually we'd think maybe just consider the unrestricted funds. If you look at the Charity Commission guidance on reserves are all held in the unrestricted funds, but sometimes it might be that other funds are helping out with that too. And also as part of this, we need to consider what the SORP's requirements are. Now on the next slide, we're just to look at how we might think about whether a charity is solvent or not. This is a set of accounts set out in a similar format to a company. So similar to how Matt showed you what a company might present as its balance sheet. Here's a very simple presentation of a balance sheet, just straight up and down, showing that the charity's got fixed assets, it's got current assets, so that might be cash debtors, etc., and it's got some current liabilities deducted from that. The bottom half is in charity format. It's showing you that that's distributed between the restricted funds and the unrestricted funds. But the key things a company accountant might look at is that net current assets is a positive number. That's always good news. And that the total figure on the balance sheet is 1.1 million. But if we move to the next slide, what we see is a presentation that's required of charities. Now, some charities will present their balance sheet in the primary statements of the accounts in this format. Most others will present it, well, all others will present it as a note to the accounts. It's if you don't present it as your primary statement, you need to have this as a note to your accounts. And when the accounts are presented this way, in a similar way to the statement of financial activities that Matt showed you, it's much easier to see that actually the news for this charity is not all good news. So the fixed assets, as we would have seen, are always treated as outside funds available for spending. The current assets are split between the designated funds, general funds, and restricted funds. But because some of them are designated, that means that when we look at the creditors, all of those creditors are offset against a very small amount of current assets. And in fact, this charity, if you look at the detail behind where the assets and liabilities are sitting, has a deficit of liabilities in its general fund of 300,000. So assessing whether a charity is solvent is a much more complicated exercise than maybe it is for a company. And you should always look for that note in a charity's accounts if you want to get a fairly quick view on whether a charity is solvent or not. So moving on to the next topic. Accounting policies. Matt hinted at the fact that part of the accounts is the accounting policies. They're a very important part of the accounts, really, for telling whether there are specific judgments that have been made that you should be aware of that might make a difference between different the way that one charity might present things compared to another. Matt's highlighted, as I say, a lot of things that are areas of principle that are clearly set out in the SORP or in generally accepted accounting practice, so general company law, etc. But within the general principles, there are quite often specific assumptions that can be made, and also choices that might enable fine little distinctions to be made that lead to very different decision making. And we'll look at these in turn. So depreciation, Matt mentioned, we'll have a quick look at that in a second. There is the issue of timing, and that often is around straightforwardly cut off, which is whether accounting transactions have made it into the right year or not, but also around recognition, which is conscious decisions about which year a transaction belongs in. So whether income should be brought into this year or carried over to next, for example. Those issues of certainty and measurement that Matt talked about, and entitlement and obligation are the criteria all underlying whether items are recognised in a particular set of accounts or put into another period, for example. And then the fact that there are greater disclosures needed around some of these judgments and matters of estimation, and we'll look at a couple of those as well. So on the next slide, these are just a few pictures that just illustrate some of the issues around depreciation. And Matt said earlier that endowment funds are one of the concepts that give our trainees difficulties to start with. I remember very well when I first did basic bookkeeping, depreciation, something that gives almost everybody a bit of a problem when they first hear about it and have to deal with it. It's a kind of counterintuitive way of dealing with things, but it's really all about spreading the cost of a fixed asset over the life of the asset rather than taking the whole of the expense into the year in which you actually part with the money. And it's a very judgmental area because it involves, first of all, deciding how long you think you'll use the asset for, and then systematically recognising that expenditure over that period might be something you do by just taking an equal amount each year, or by doing it on a sort of a reducing balance basis, for example. So there's a lot of subjectivity around accounting for depreciation. The first example is a property. And practice around properties has varied massively down the years. There was a lot of general practice 20 years or so ago where organisations would say quite intuitively the value of property tends to go up, not down, so what's the point of depreciating it, and just simply wouldn't provide depreciation against properties. Accounting standards have become tougher and tougher around that, and now we're expected to write buildings off, for example, over a maximum period of 50 years or shorter if they're on a leasehold. But that specific decision around whether you write it off over 50 years, 40 years or 30 years, for example, can make a very, very big difference. And if you do somehow argue that the residual value of the property is so high that the amount by which you're consuming its value between now and when you eventually sell it, for example, would be very, very small, there'd be no depreciation charge in your accounts. So property depreciation can make a massive difference to a set of accounts. The next item is a very, very, very old piece of IT equipment, a Babbage engine, but it's really there just to illustrate that there was a bit of a fad for writing off computer equipment over just 1 or 2 years, maybe in the 90s and noughties. We probably all know that in charities, these things get used and stretched over a much longer period than that, really. And again, it's really just a blunt instrument to make the simple point that deciding how long to write assets off over can make a bit of it, can make quite a significant difference to the charge that goes through the accounts each year. And then the last example is a bit of a nuance in charity accounting. The SORP's become a bit tougher over its last two iterations on something that's called component accounting in the SORP, which is looking at an asset. This is the SS Oldenburg, if I remember rightly, and a ship has lots of different aspects to it, lots of different components. It might well be that the basic superstructure of the ship, the hull and things like that, will last more or less the entire lifetime of the ship, which could be 60, 70, 80 years. But a lot of the things that you can see sticking out above water, like the radio masts and things like that, will need to be replaced much more frequently. And all component accounting says is that you should look at that not as a single asset, but as a floating basket of different assets, and each major component should be written off over its own particular useful life. Now, of course, that only makes sense for very significant items like the engine or the radio systems, for example, rather than every door and window. But again, those kind of judgments around which bits of assets you recognise and how long you write them off over can make a big difference to the numbers that show in your annual accounts. And moving on. Matt went into this in a bit of detail, so I won't cover it for too long, but that whole aspect of when to recognise, in this case particularly income in a set of accounts, is very important to the final results that get disclosed. In this case, there are three examples of different kinds of income where a bit of judgment might be involved. Matt mentioned that a commitment to give income can be recognised in the accounts. The first picture is from a TV reality show where I think that's JB Hewitt, isn't it, blurted out at the end of the show that he was going to give the money to all of his prize winnings to one of our clients. Our client quite rightly concluded that that was a fairly binding commitment because it had been made in front of millions of TV viewers, and banked the income in the year in which he declared that on television, despite the fact that the money didn't come in until slightly after the year end. And we felt that was appropriate, but that was very much a judgment call. The next example is mobile phones being sent out to other countries, and when you recognise the income from those kind of goods can vary very significantly. For some items, if they're donated to be sold on, you should in principle recognise them when you receive them. But most charities find it very difficult to value those kind of items. For example, clothes that are sold in charity shops, I would only recognise them when they actually convert them to cash. But if those phones are going to be refurbished and then distributed at no cost, you would generally recognise them as they're distributed. And the final example is probably the biggest one that makes a huge difference to some charity sets of accounts, which is all to do with paperwork. And the SORP says you should recognise income when you're entitled to receive the funds, and that purely administrative reasons aren't a good enough reason for not recognising income on time. In this case, you might have two charities that receive a very significant grant from the same funder. One of them has looked through the grant agreement and seen that there's a clause that says we won't pay you this money until you've submitted a final report, and they interpret that clause as meaning that they're not entitled to the income till they've submitted the report. The other charity might, in my view correctly, have interpreted that as a purely administrative procedure and decide that as soon as it spends the money, it's entitled to reclaim the funding and recognise the income as it spends it. Now, what would happen in those two charities is the first one, if the project was still ongoing at year end, would recognise no income at the end of that year and would show a deficit on its funds because it had spent money that it wasn't recognising any income to cover yet. The second charity would conclude that it was entitled to recover all of that money and recognise income to cover those expenses and show a nil balance on its funds at the year end. And that can make millions of pounds worth of difference to some charities in a given year. Decision as to what's significant and what's not. Moving on to the next slide. And I won't spend any time really looking at this because I think Matt's already covered this in plenty of detail, but items which really do have a lot of subjectivity to them. Legacies, as Matt mentioned, that there's a big difference can be made by when you bring legacies into your accounts. Provisions, contingent assets and liabilities, they're the only bit I will mention. Where Matt established that there are differences in the timing of recognising liabilities, it might be the case that you've clearly got the risk of a liability. You haven't quite met the criteria for recognising that as due at year end. But there are disclosure requirements for things where you may have an expense as a result, for example, of a dispute with a supplier or a court case or something. And where there are things that might crystallise, and it's more probable that they will crystallise than not, there are absolute requirements to disclose those in your accounts. And next slide, please. Some examples of those come into this heading of entitlement and obligation. So Matt split it down into those three criteria for recognition. Deciding whether you're entitled to something or you're obliged to do something at year end can be quite tricky. And some of the typical examples that come up for grant makers, for example, multi-year funding. So where a grant maker funds somebody to go through university, they should in principle recognise the entire expense of putting that person through university at the start of their course, unless there's a condition that at the end of each year, for example, they might review the student's progress and will only continue to fund them if they're taking the course seriously. Now, if there is a clause like that and it is executable, it doesn't have to have been executed in the past. You don't have to have stopped anybody's funding as long as the clause is actually usable. Then you would recognise each year's funding as the student demonstrates that they're still taking their course seriously, for example. So you would hold back the funding and just disclose a commitment that you had agreed to fund that student. There's a difference between constructive and moral obligations, which I think Matt's already covered off, but constructive and moral obligations are ones where the legal paperwork might not make you legally responsible for paying something, but you would definitely suffer harm if you were seen to be not fulfilling your obligations. And the next slide. I said I'd talk about designated funds, and I'm conscious that I need to let Amanda have a chance to have her fair share of the presentation, so I'll whistle through the next few slides. But designated funds, Matt's already established. These are discretionary funds. You decide to set the funds aside. You can equally decide to put them back again. There has been a big pushback from the SORP making body that these funds should actually have a substance to them, because historically people did present their balance sheets in a way that showed they had designated funds and very little by way of free funds, and that was frowned upon. So now you have to be able to demonstrate the funds are for a specific purpose. They may be for things like covering wind-up costs of specific projects, etc. Other examples can include money that you've got set aside because you've already made grant commitments but not recognised them in your accounts, for example. But what they shouldn't be is just an accounting device to be able to report a lower value of your free reserves. And the next slide. So the last thing I said I'd look at really is that reading between the lines. So what kind of things should trigger you to be asking more questions? One thing that should be disclosed in a charity's accounts is where they have restricted funds and endowments, etc. There should be a description of the material funds that the charity holds. Now, if a charity has simply got a row on its balance sheet that says restricted funds with very little explanation following that and no analysis of what's come into and been paid out of those funds during the year, you might wonder how well those funds are being managed and how well they're understood by the organisation. What you should expect to see is a good description of each fund and a pretty clear account of what's come in and gone out against each fund. The reserves policy, which we deal with in a lot more detail on another course, but the reserves policy is essentially the charity's assessment of what it needs in the piggy bank to help it cope with uncertainties. That reserves policy should be fairly clear, but the thing that should make your ears prick up, that's not what you're going to do if you're reading, is it? But anyway, the thing that should make you a little suspicious if you find it is if the reserves policy keeps changing each year and the policy magically equals roughly what they already hold. So looking at a charity's reserves policy and making sure it's clear. That spread of assets over funds note I showed you earlier that shows where the assets are sitting in relation to the different funds is pretty important. And Matt highlighted related party transactions before. And if you know there are relationships between a charity you're reviewing, maybe with a view to paying a grant out to or you're a trustee of, and other organisations, you should wonder why, if there's no disclosure about the relationships with those organisations, whether maybe there's something people don't want to put out into the public arena. So those are just a few of the areas where the accounting can be very much determined by judgments and decisions that are made by trustees and where trustees should ask a few questions just to make sure they understand the decisions that have been made. And I'll now hand over to Amanda.
Thanks, Eddie, and good afternoon, everyone. I'm actually now going to move away from the numbers. Some of you might be relieved at that, and talk about the narrative that goes alongside those numbers, really in order that people can understand the numbers and put them into context. So if we go on to the first of my slides, really just to emphasise the importance of this document, we're living in a world where charities are increasingly under the spotlight. We have a regulator, and we know for sure that that regulator, the Charity Commission, is beginning to read charities' reports and accounts and make comments on them. We know also that aspects of the media have become very interested in the charity sector, particularly because some of the problems that a number of high-profile charities have had over the last few years. And so the expectation of the Charity Commission is really that trustees of charities are demonstrating that they understand their responsibilities and they are giving a good account of the stewardship of the assets of the charity for which they're responsible. And that all comes back down to how do you do that? And one of the key ways of doing that is through a trustees report. So what I'm hoping to do over the next 15 minutes or so is to convince you that this report is something that as trustees you should be involved in. It may not be drafted by you, it may be drafted by the management, but it's certainly something that you should be giving time and priority to reviewing and making sure that you're happy with. Because these days there is no such thing as a private charity. Every charity has to account for the way in which its assets have been looked after and stewarded. So on the next slide, one of the really this just sums up what the purpose of a trustees report is. So as I said, many of the people looking at your report and accounts will not necessarily be financial analysts. They may not understand the detail that's in that statement of financial activities and balance sheet that Matt explained. So this gives context to the financial statements. It explains what the figures mean. Many of the figures, remember, may be quite large when compared to the numbers that many people looking at this document may be used to actually looking at and understanding. What it does do, though, is hopefully it demonstrates that that charity is using its resources properly, that it's using them for the purpose for which it was set up, and that they're being used in an efficient and effective way. It is also a means by actually demonstrating that as well as using those resources for the purpose for which the charity was set up, in using them, that charity is benefiting the public or sections of the public, and it really satisfies the public benefit reporting requirement that you have as trustees. It occasionally will help to give balance as well. So Matt explained that occasionally it's necessary to account for a legacy a long time before the money is actually received. So your accounts may look as if you are quite rich, whereas actually you may be cash poor because the money hasn't yet come in. And that sort of thing can be explained in the trustees report, as well as, you know, some of your plans didn't work out. You can explain why they haven't worked out. You can explain why you need more money and so on. A good report will also show that the charity is properly run, that it's got good management, that it's properly organised, and that it's carrying out the activities in an effective way. It also should act as a marketing tool. Not everybody that looks at your report is looking at it from a regulation and compliance point of view. Many are looking at it because they are interested in your charity, they want to find out more, they perhaps want to support it, either by volunteering or by giving money. And one of the things that we do know at the moment is that 10 years ago, 8 in 10 members of the public gave to charity. Today, it is 6 members of the public out of every 10 that give to charity. So resources that are available to charities are becoming more scarce, and hence the need for you to explain to the reader why your charity is deserving of their money. Now you might ask, and I've set this out on the next slide, who is going to be interested in looking at our annual report and accounts? Well, inevitably you have to file them with the Charity Commission, so the regulator is going to look at them, and as we said, there is evidence that they are beginning to do so. But it doesn't stop there, and many charities, I think, would be surprised if they knew how many times their accounts are accessed on the Commission's website. perhaps by beneficiaries and people who are using the charity's services or people who might use them in the future, by other charities, perhaps charities that you're working in collaboration with, or charities that are in a similar area of work. Your employees and volunteers may want to look at how well the charity or the organisation they're working for is actually doing. And suppliers and service providers, particularly if you're entering into a new contract, may want to make sure that you've got the financial ability to meet the terms of that contract. Inevitably, aspects of the media are going to be interested from time to time, and you will also find specialist researchers occasionally want to look at aspects of the sector in which your charity operates. And I think when you're drafting a trustees report, the one thing to bear in mind, and the one thing that all of those people are going to be interested in, is what impact has our charity had over the course of the year. So if we go on to the next slide, getting the structure right is absolutely key, because you want to make sure that people read the information that's going to be relevant to them. Now, not everybody is going to read a trustees report from start to finish. In fact, very few people will do so. So you need to think about who is going to be reading this report, what is our audience looking like? And therefore think about what is the appropriate order of the contents. Now, what I've put on this slide is a suggestion that will, I think, suit many charities. It won't suit all. But as we go down these, you'll see some of the aspects that I think perhaps need to give more priority to. Many people want to know why your charity was set up and what it's done, what it's achieved, and they should always be at the front. But you might want to just preface those with an executive summary or a chair's report, really highlighting the key aspects that if somebody just looks at the first few pages, what's the message that you want them to go home with? Think also about the length of your report. Typically, it needs to be a relatively long document, but I would say if you're getting to more than, say, 20 pages, you're perhaps going a little bit over the top. Don't think that it just needs to include words, so it's not just narrative, it's photographs, it's quotes, it's diagrams, it's things that really bring alive what your charity is doing and what it is about. And remember, you don't have to say everything every year, so vary it each year. Perhaps have a topic that you want to cover and focus in on each year, so that every year it's slightly different and it encourages people to retain their interest. Now, if we look at the various sections that make up the report, the first is the reference to administrative information. Typically, this either comes right at the beginning or right at the end. You'll see the information that needs to be in there set out on that slide. It basically states who is responsible for the charity, where they can be contacted, and so on. The thing to remember, because you do want this to be a marketing tool, a communication tool, remember to put contact details such as your Facebook address, your Twitter hashtag and things like that, so that people can know immediately how they can find out more information. Following that is normally the next slide, what's on the next slide, which is to talk about the structure, governance and management. So how your charity is set up, and typically this would usually be the last part of your trustees report. So it talks about what type of charities constitution you've got, whether you're a trust, whether you're a company, whether you're a charitable incorporated organisation. But importantly, it's the section where you talk about how you recruit and appoint new trustees. Now, there's no right or wrong answer to the way in which you do that, but it's important to be transparent, to talk about, if you go through a recruitment process, but also to think about how you ensure that your board is as diverse as possible, how you ensure that you've got the right skills and qualities within those trustees. And to talk also about how you ensure that those trustees know what their responsibilities are, not just in terms of their legal responsibilities, but how they become understanding of the organisation that ultimately they're responsible for. So their induction into the organisation itself. You might also want to talk there about the way in which your management team liaise with the trustees and vice versa, and other organisations that it's important that you work in collaboration with if you're to achieve your purpose. Now on the next slide, you've just got an example there of what the minimum really that needs to be talking about in terms of your trustees. So littered with all amongst these slides, I've got a few examples. I will skip over many of them in the interest of time now, but they will be in the slide deck that will be distributed after this webinar. But this one simply explains some of the minimum detail in terms of the appointment of your trustees. So the minimum number, the period of office, the way in which the skills are assessed, and the induction. Moving on, one of the most important parts of your trustees report is talking about why your charity exists, what its objects are, what its mission or its vision is. And really within this, you need to set the scene. And it may be that you give a little bit of history into the founding of the charity, the work that it has done in the past. But ideally, what you need to summarise are your objects. Now, some charities will do that by quoting directly from their governing document. There's nothing wrong with that. I personally would discourage that from being done. I think it's much more important that you set your objects out in a form that most people can relate to. Most charities will have a vision statement or a mission statement, and it's that sort of thing that you really need to be explaining here, together with the specific areas and your aims, what you hope to achieve in the short, medium and long term, and the strategies that you're employing in order to achieve those aims. Now that's all well and good, setting out what your strategies are, but how do you know when you've actually achieved them? And what you need to be explaining to the reader is that you do have criteria for success. You do have ways of measuring how successful your charity is in achieving its goals. You need to talk then about the work that you do in terms of the significant activities and link that back to your accounts. So where you've described your expenditure, make sure that there's some consistency between that description and the description you're giving in your trustees report as to the activities you've carried out. This section is also where you probably confirm that you've read the guidance from the Charity Commission on public benefit. Personally, I wouldn't go any further than that in terms of public benefit, because when we get to one of the other sections of the report, you'll see that it should be absolutely obvious, if you've written this report in a good way, that your charity is providing public benefit more than enough to meet the requirement of the Commission. Finally, within this section, you'll probably set out a number of your key policies, the policies that really it is important that the reader understands to get some assurance that you're running your organisation properly, that you've thought about your finances, but you've also thought about some of the critical areas of your work. So typically you would have a safeguarding policy if you are a charity dealing with children or vulnerable adults. From a financial point of view, you might want to have your grant making policy. If you are a grant making charity, you probably want to go further than that and explain to people how, what sort of organisations do you give grants to? How can they apply to you for grants, and so on. One or two other policies you might want to include there, and are becoming increasingly popular, is something like your environmental or sustainability policy, and your diversity, equality and inclusion policy. Don't forget, one of your key resources are your people. So here you might want to talk also about your employment policy or your people policy, again probably touching on diversity and equality, and also your volunteers, and giving an indication as to the value to the charity of those volunteers, and probably what you'd have to pay if you didn't have those people giving of their time freely. Now I've just got a couple of examples that we'll see that highlight this. The first is that example of talking about your objects, why your charity exists. And this is a very good example. I've chosen it because really you don't need to read the words. You just need to look at the picture and you know exactly why this charity exists. The next slide just explains, just gives an example of a charity that's given their mission in more words, but basically has spelt it out in detail in a way that is understandable and explains the various areas of work they're involved in. And the next slide just gives an example of ways in which you can perhaps explain the value of volunteers to you. One of the ways of doing it is in a tabular format like this, so explaining the areas that you use volunteers, the numbers, the hours volunteered, and the approximate value. And you might value it, say, by looking at the minimum wage and valuing the volunteer work that you've received in that way. So moving away from your object, so you've explained what it was you were set up to do. So what have you done? And this is where the section on achievements is important. And this is where you can be really creative by giving lots of photographs, lots of quotes. So this is where you tell your story in a balanced way, explaining the things that have gone well, the things that you're proud of, but also touching on some of the things that may not have gone quite as you had anticipated. This section needs to ideally include both qualitative and quantitative data. It needs to explain what those milestones were that you were measuring your achievements by, so that you can match them back to those aims that you set out in the previous section. And one of the best ways of perhaps explaining your work is to give some case studies, particularly if you're a grant-making charity. Explain what the recipient has done with your money, what difference that has made to them. Use quotes, use photographs, and talk also about the way in which your work is dependent on your fundraising and the impact of various regulations possibly on your fundraising. In this section, you also are expected to talk about what could go wrong from a big picture view, so the key risks, and to talk about what those risks are, what you've done to mitigate them, and what impact they've had on the organisation during the year. And as I put at the bottom of that slide, the key thing is always to think about what difference has your charity made to its beneficiaries, but not just your beneficiaries, to society as a whole. And is the way in which you're describing your achievements making it clear to the reader the whole way in which your charity has benefited the public? So just a few examples, and we'll quickly just put those on the screen. So next slide, you've got a grant-making charity. I've put this here just to demonstrate a case study, and I'll leave you to look at that in your own time. On the next slide, you've got an example where the charity has used creatively a photograph, but also some quotes. Quotes are very powerful because they are recipients of the charity's services saying this is a great charity, rather than you saying we're a great charity. And the next example, you've got a charity that makes grants, and here they've got some comments back from the grant recipients, just explaining the difference that that money has made to them. And the final example I've given you, the next slide, is just typically the sort of level of risk that you need to talk about within your trustees report. So not a huge amount of detail, but to give the reader basically some reassurance that you know the things that have gone wrong and they are under control. Now, if we go on to the next slide, because the next thing to do, and you're probably about 16, 17 pages into your trustees report here before you start talking about the numbers. And the idea here is not to talk the reader through every single number, but to give them an overview. So to talk about where your income comes from, where your expenditure has gone, to talk about any particular funders or sources of income that you're particularly reliant on, to talk about if you have money that you're not spending because you're investing it, talk about why you're investing that money, and talk about how well your investments have performed over the year. And then to relate all of that to your reserves policy and your financial position. And on the next slide, I just talk about that in a little bit more detail. So you want to really give the reader an indication of the amount of money on reserves and resources that are available to you at the end of your financial reporting period. You want to talk to them about any restricted monies that you've got and when you're going to spend that. You need to be identifying those designated funds that Eddie talked about. And as he said, the Charity Commission are becoming slightly more insistent that they are funds set aside for a valid purpose. So talk about what the purpose is and when you're likely to spend that money. Talk about the performance of your investments. Talk about the free reserves that you have at the end of your accounting period, and then compare those to the policy that you have on reserves. And as Eddie said, not all charities would expect to always meet their reserves policy. And in fact, if you have a charity that's consistently meeting its reserves policy, you might become a little bit concerned. But the important thing is to say, well, how are we going to meet our reserves policy in the medium to long term? So if we need more reserves, how are we going to get them? How are we going to reduce our expenditure? If we need less reserves, what are our plans to actually spend that money going forward? And you'll see a couple of examples that I put into the pack. So on the next slide, you've got where you've done this in a narrative way, and in a way where basically the reader is being talked through the bottom part of the balance sheet and explaining why funds have been restricted, or what funds are restricted, why funds have been designated, what the free reserves are, and then comparing them to that figure that they would like those reserves to be in an ideal world. Again, depending on your audience, your trustees report, they may not want narrative. They may want something that is easier to look at, perhaps more understandable. So here you've got a financial review where you're talking about your income in graphical form. And then the final part of your trustees report on the next slide is really, rather than looking back and looking at the history, talking about the future, because you want people to support you in the future. So it's important that you're talking in an exciting way about the plans that you've got. But remember, the plans that you set out this year in terms of what you're going to do in the future, you need to be reporting on next year and saying whether you've achieved them or not. So don't create a rod for your own back. Don't go into a huge amount of detail. And remember, if you're not the sort of charity that's radically going to change what you do, business as usual is okay. And as I said, don't be too prescriptive and cause yourselves a problem for next year. And again, finally, what I've left you with is an example of a future plans. And again, very much in this particular example, business as usual, with just one or two areas that are going forward and are changing quite dramatically. So that's a really quick canter through a trustees report. I would just say that I'm an accountant and I think the trustees report is far more important than the accounts in terms of the reader of this document and making it clear why your charity is existing and what it has done. And with that, let me hand you back to Eddie.
Great, thank you for that, Amanda. I hopefully that's given you a good overview of the topics we said we'd cover this afternoon. And the only thing I'd like to say is that I wholeheartedly agree with what Amanda just said about the narrative making sense of the numbers, because yes, you'll have probably already gathered from some of the things Matt and I said, the numbers have their own strange logic sometimes as well. But we haven't, I'm afraid, got time to go through any questions and answers now. So thank you very much for listening in, and we'll sign off now.